Very good evening to all of you. Welcome to practical session number 25 for the year 2024. Myself, Srijit Kakkar, and today is Sunday, 30th of June 2024. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, involved in the market, and also about the copyrights. Moving ahead, I would like to add that recently we started a channel on WhatsApp, and this channel is basically dedicated to keep you guys updated with the latest videos, schedules, if we have any updates or any offers. So you can scan this QR code to join the WhatsApp channel, or in case you want the direct link, you can find it in the description. So once you go to the description, you'll have the link for the channel. You can click on it and join the channel. And yes, today is our practical application of demand supply methodology, like we do every other weekend. Now, the demand supply methodology course we had was a paid course, and sometime back we made it as an absolutely free course. So, in case you don't know the methodology and you wish to learn it, you can go into the description. You'll be able to find the link to the lessons, to the videos using which you can learn the complete methodology. It is available in both the languages, English as well as in Hindi. So going through those lessons will help you understand what is demand supply methodology theoretically, how it should be applied, what is the procedure. But unless and until you go through practical sessions, it's not very easy to start applying the process. And that is what we do in these live practical sessions. So every weekend, I do a practical session where we take an example to which we apply the complete methodology to give you hands-on experience of how to plan trades in a very mechanical and rule-based way using demand supply methodology. Now, the examples which I share with you, yes, eventually some of them will get triggered, and whenever they get triggered, we also review them. So we have quite a few examples to review. One was getting carried forward, and there are two which got triggered this week. So we'll start with the review of them. And once we are done with the review, then we'll start with our example for today's session. So the very first one for review is the example that we took in session number 13. And this session was on 31st of March. So the beauty is that all these analysis I'm doing, during these sessions, it's not that after the move has happened, I'm always doing the analysis beforehand. So even if you go back and you watch the recording of the session number 13th, which was on 31st of March, that is the time the chart would be something like this, that we would still not be in the zone, and eventually prices came into the zone, and that is where we got this move. So we have been tracking it for the last few weeks. And you can see we already got a move which was probably a 6:1 kind of a move. But we talked about, depending upon your personality style, some people still might want to trail onto it. So last time we talked about your trailing stop loss could have been somewhere around here, which is this recently formed drop base rally. Now, what happened was during the week, we also had formation of the supply area, which is a drop base drop. So once you have this formation of supply, now we know that from the supply, prices can again go down. And at this point of time, this would also be a fresh supply for us. So this is where we would have to revise our target because supply has formed. And if you're not booking your profits, you can see from that supply, prices can again start moving down. So eventually, even though we had a move which was over 6:1, going with the most conservative trade plan that I've given you, we had a formation of a supply area, which is where we should have revised our target, and the very next day we would have got our target, and it would have still given us a little over 2:1. So you can see that's your risk, and that's your 2:1. So that's your 1:1. That's your 2:1. So you would have got approximately maybe 2.5:1 on this one. Right, but like I talked about the previous session, that I was already out because we had some zones on different time frames using which I planned my exit. So yes, see, again, what happens is when you're learning the methodology, it definitely makes sense to make it a little simplified for you, because from the very first day, if we start looking at a lot of time frames, it can be quite confusing. So that is why when we are starting with very limited number of time frames so that the process is easier for us to apply and to manage. But yes, as you start gaining more and more experience, you will be able to use multiple time frames and combine them together to have a better understanding of when to enter the trade, when to exit the trade, where to exit the trade. So using those different time frames, I had planned my exit, and that is what we talked about even the last session, that I'm already out of this trade. But yes, if you were still into it, you could have easily got about a little over 2:1, which is still not a bad reward to risk ratio. But yes, compared to the kind of move which we had, and this is what I was also talking about the last session, that once I see these good moves. Generally, I'm not very greedy, right? If I see, okay, this is where some profits can be booked, I generally don't even go for partial profit booking. I exit my 100% positions. So yes, I was out of this trade. But yes, otherwise, those of you who were trailing onto it, you could have still got about, a little over 2:1 on this one. All right, so that takes care of the one which was getting carried forward for the last few weeks. And now we also have two examples which got triggered this week. So let's look at them. Give me a second. Let me bring them up. All right. So the very first one is this one. We did the analysis for this on the session number 22nd of the year 2024. And this session was on 8th of June. And here you can see when we came into the zone, which is right here, reward to risk ratio was spoiled because at this given point of time, our opposing zone would be this drop base drop, which is only showing us less than 1:1. Now, technically, if your reward to risk ratio is not good, we should definitely not be participating in that trade. So because of reward to risk ratio, we should have avoided it. But yes, one thing we could have checked is that if we were planning the trade at the best locations, the targets can be from the intermediate time frame. And in this case, we were not at the best location. That is what you can see. Your best location was, still lower. So reward to risk ratio was definitely not conducive. But like I always say, different traders, different personality styles. Some people might be even happy with having that small little profit, in which case you can see the very next day we hit our target. So this is where your entry would be. The very next day you hit the supply area, and the whole week we just kept hovering within these areas of demand and supply. Now eventually what will happen is either the supply will get violated and the prices will continue with the move to the upside, or maybe the demand will get violated and the prices will start moving down. But as a rule-based trader, we always plan trades where the reward to risk ratios are at least 2:1 for us, which was not the case here. So going with the rules, this is a trade which was not valid for us by the time the prices came back into the zone, and the only reason for that trade to get disqualified is a bad reward to risk ratio. All right, so that takes care of this one, and we also have another example, and this was just give me a second. All right, done. All right, so this was session number 23, which was on the 15th of June. So on 15th of June, we did the analysis for this one. So here you can see when the prices they started coming back, we definitely had an opposing zone, but this was already tested, so not a challenge for us. So this is the candle where you would have entered the zone. Now the problem is at the time of entry, the zone would have not formed, and the reason is because this is the daily time frame, and on the daily time frame at the end of the day, the candle will close and then we'll have formation of a zone, because before the end of the day prices can again move up. So now the problem is that at the time of entry, reward to risk ratio was not a challenge, but after the entry, right after this candle closed, your reward to risk ratio was spoiled. So now you only have one choice, and that one choice is that revise your target just below this area. That is how we define our targets. And you can see the very next day it could have given you that exit, which would be almost break even though the stop loss has not yet been hit. But since we are following rules, based on the rules, your reward to risk ratio was spoiled. You should have exited, and wherever the chart was showing you the target, which was as good as break even, you could have got your break even exit on this one. All right, so that takes care of all the trades, which were trade examples, I should have said, which were getting carried forward or they got triggered during the last few weeks. And now nothing is getting carried forward. Everything which was triggered has been reviewed. So we can now start with our analysis for today's session. So just give me a second. Let me bring up the chart, which we'll be analyzing today. And perfect. So that's the one we'll be analyzing. All right. So coming back to whenever we talk about trading, I always say trading has to be a mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. Title of that video is How to Start Trading. Now, during the session, if I talk about some videos, if I talk about some documents, all the links are available in the description. So do not worry where do you access those videos or how do you access those documents. You will be able to find the links in the description. All right, now what happens is it's easier said than done that yes, you need to have a mechanical rule-based process, but when you're learning something new, it's not very easy to create a trade plan for yourself. And that video, which is How to Start Trading, will help you understand that why it is very, very important that we start uh, you know, being a rule based trader, because it helps you understand whether your methodology is working or not working, and it gives you that opportunity. You can fine tune it based on your experience by ensuring that you do not incur a very big loss. And that is how you start progressing as a trader. And eventually, once you start doing that process in a mechanical way, it also helps you be a mechanical trader versus taking your trading decisions based on emotions, which is very, very important. Now, like I said, when you're learning something new, it's not easy to create a trade plan from the day one, because you're lacking that experience, and only with experience you'll be able to create a trade plan. So to overcome this challenge, I have created a trade plan for you, which is a combination of two documents. The first one is your trade plan steps, which is basically a flow chart. You can also call it as the walkthrough, which guides us what we need to do as a demand and supply trader step by step. Now, all these steps, they have their own elaborate rules, which can be found in the rulebook PDF. Again, I'll add, this rulebook is a conservative approach. With time, with experience, you can definitely modify to make it better suit with your personality style, but at least you do have a starting point using which you can start planning your trades very mechanically, very rule based. So what is our step number one whenever we start planning our trade? Step number one is we need to define our trade purpose. Now the question is, what do we mean by trade purpose? Trade purpose implies what will be the expected duration of my trade. And why are we starting with that? Because when we do our analysis, we use charts which are time based charts, and we have n number of time frames available to us. So the very first challenge we face is that out of these n number of time frames, which time frame should I be using for my analysis? And to overcome this challenge, we do not start by randomly selecting any time frame. We make the process very logical, very mechanical, and the logic that we follow is that the longer I want to be in the trade, which means the longer I want the duration for the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So that is why we first define our trade purpose, because it will help us identify what time frames I should be using for planning my trades. Now, what I've done is I have okay. Now, before we move on to what are the different trade purposes, I would also like to add that when I'm talking about the duration of the trade, the duration is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss. So it can be any kind of exit. It can be in profit, it can be in loss, it can be break even, any kind of exit. So now what I've done is I have divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income is a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks, and monthly income is a trade which can last for a month or few months. Now, very important, by definition, I say daily income is a trade which can last for a day or few days, but when you're trading markets which are not 24-hour markets, I'm pretty sure you would have experienced whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is, if the gap is in your favor, you might get profit which is bigger than what you were expecting. But similarly, if the gap is against you, you can also lose more than what you were willing to lose on that particular trade. So we understand that whenever we keep a position overnight, it has that inherited overnight gap risk which cannot be avoided. And that is the reason my recommendation to all of you would be that your hourlies and dailies initially should be done strictly as intraday trades, because we don't want to take that unnecessary overnight gap risk. Now, weekly monthlies, we are not anticipating to get the exit the same day. So here we have no choice, but we'll have to keep these positions as overnight positions. But as you start having more and more experience, you start building up confidence into your analysis. If you want to include the daily incomes into overnight rates, that can be done. It's just that initially we would like to avoid that as a risk management rule. So my step one is I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 in the rule book, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame, it is based on multiple time frame analysis. So what are the multiple time frames that we utilize? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify the areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the four different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that what will be my different time frames for these different trade purposes? And we get the answer from this table. Like in this example I opted, I want to plan monthly income trades. So as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the higher time frame used for curve analysis. Weekly is the intermediate used for trend analysis. Lower time frame is daily. That is where we get our ACTS from. ACTS stands for stop loss entry target and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type to type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Now mind it, this table is for the NSE market, which is only open for about 6 hours and 15 minutes. Now if you're trading markets which are open for longer duration, you can refer to the table which is on page number 32. This can be applied for commodities, forex, cryptocurrencies, right? Let's say you're trading some stock markets which are again open for longer durations, that is also where this can help you. So yes, once I am done with my step number one, I got to know what time frames I'll be using. In this case, monthly, weekly, daily, and 60. Plus, I also know what is the purpose of each and every time frame. So my challenge number one is taken care. Now, once you're done with your challenge number one, now we get on to the next challenge. That is, I do know my time frames, but in this example, if I talk about NSE, we have over 2000 companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So now the second step is that from this very big array of symbols which are available to us, I need to find a way to get a smaller list, because if I have a smaller list, I can do my analysis almost every other day. But if I have to go through 2000 companies, not an easy task. So that is our step number two of selecting some symbols out of this big list so that I can do my analysis and I can try to identify which of them are matching with my trade plan. Now, how do we do this? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs they work is that we input certain conditions into them, that these are the conditions I'm looking for. And then the scanner screener identifies that out of these n number of symbols, which symbols are matching with those conditions. And whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a small list. Now, a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created some scanners for you, which are based on some moving averages and they can help you in shortlisting some symbols. Second example, if you search on my YouTube channel scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Similarly, on my YouTube channel, search for top-down analysis, and you'll be able to find the video on top-down analysis as well, which can help you in shortlisting symbols. So these are 3-4 different examples of scanner screeners using which you can get a smaller list for you, but you're not restricted only to these 3-4 scanner screeners. Let's look at few examples of how to do it before we move ahead. So like I was talking about, that once you go to a website, under the free tab you have the stock screener. Because I opted I want to plan MIT trades, I can click on MIT. I can run the long scan and the short scan. So here you can see the long scan is shortlisting only one symbol for me, and the short scan is shortlisting 4 symbols for me. Now, very important thing which you always have to keep at the back of your mind: no matter what scanner or screener you're using, whatever results you get, you can never blindly buy or sell these symbols. So just because the screener is telling me LNT as a long scan result does not mean I'll blindly buy LNT. And similarly, just because it is telling me these 4 symbols for the short scan does not mean I'll blindly sell these 4. The job of the scanner is never to tell you what you need to buy or what you need to sell. The job of the scanner is, I can't analyze 2000 plus companies every day. So out of 2000 companies, it helped me give a list of only 5 symbols. So now I need to analyze these 5. Out of these 5, if anything matches with my trade plan, I have an opportunity available. If nothing matches with my trade plan, I don't have any opportunity available to me. So always remember, whatever results you get from scanner screeners, they can never be bought or sold blindly. Now, many times what can happen is the screener might not generate any result for you, or the list might be a very small list. So if you want to have a little bigger list because maybe you want to go through more number of symbols to identify opportunities, then what you can do is you can see that in this scanner I have given 5 different conditions, and out of these 5 conditions you will disable the third one. You'll run the scan again, and I'll do exactly the same thing here. Disable the third one and run the scan again. So initially you saw that in the long scan it was only giving me one result, but after disabling this condition it is giving me around 67. And if I go to the other one, we have around 13. So we have 67 plus 13, which is 80 symbols to look into. So you can see that after making some changes, our list from 5 symbols got up to 80 symbols, which I'll say can easily be analyzed in about half an hour, maybe 45 minutes. So yes, if you want to have a bigger list, you can do that. And again, this is not the only screener available to you. If you go to the screener section on this website, you can see that it has over 150,000 scanners available to you. Some are based on fundamental analysis, some are based on your top love, then you have your candlestick patterns, then you have your range breakouts, bullish scan, bearish scan, then you have intraday bearish, intraday bullish, crossovers. So you have n number of scanner screeners available to you, and this is just one website. Similarly, you can go to Google, you can do a Google search, you'll be able to find n number of websites and number of scanner screeners available to you. So in this example, you saw we got a list of about 80 symbols. Now, once you start analyzing them, there are a few challenges which you will realize. Challenge number one, you will realize that when you do your analysis, you're wasting a lot of time analyzing such symbols where you don't have a quality demand zone or a quality supply zone on the lower time frame. And if you don't have a quality zone, you're just basically wasting your time doing your analysis. So it's a lot of time wastage because uh, opportunities are not available and you're still analyzing those symbols. Second problem is that some of these symbols which might have some quality demand or supply areas on the lower time frame, they might be very far away from the current market price, due to which you'll have a longer waiting period. And during that waiting period, wherever price action develops, it might disqualify the setup by the time it is back into your zone. Like you saw the example today, our session number 22 and 23. By the time prices they came back into the zone, the reward to risk ratio was spoiled, and which is where we had no choice but to skip those opportunities. So these are some challenges which we will be facing when your analysis on, I shouldn't say analysis, when your screener is based on conventional technical analysis or fundamental analysis, because whatever results we are getting from those scanner screeners, they have nothing to do with demand supply zones, because these scanner screeners are based on either conventional technical analysis or fundamental analysis. And to overcome these challenges, I have also created two custom built tools. One is called as the alert service, the other one is called as the screener. Now, if you want to have more information, what is alerts, what is screener, the link to the walkthrough videos are available in the description. You can go through the walkthrough videos, you can understand them better. Now, just to again show you as example, what alerts they basically do is that as soon as you have a formation of a zone on the lower time frame, it immediately notifies you. So here you can see I'm showing you example of our demo channel. So we have demo channel for NSC, we have demo channel for Forex, we have demo channel for MCX. Now on the NSC channel, what we do is from 11:15 to 11:45, which is half an hour. On trading days, we give you alerts as in when the demand and supply zones are getting formed. So here you can see this is for 28th of June. So as soon as we have formation, you can see at 11:15 we got an alert that on Jubilant Food we have a drop base rally on the 60 minutes time frame. This is proximal, this is distal value. So it keeps updating you live as in when these demand and supply areas are getting formed. Very, very important. These are not call giving or tip giving services. This is a scanner which is purely based on formation of demand and supply area. So you get to know live where these zones are getting formed. Once you get to know where these zones are getting formed, you can match those zones with your trade plan. If they qualify, they can be your opportunities. If they don't qualify, you can simply skip them. So that is what alerts basically do. And similarly, we have another tool which is called as screener. Now, the way screener basically works is that in the screener, you can give your list of symbols. Like here, you can see I have applied the screener once to one chart. You can apply to a number of charts, a number of layouts, and you can have a very big list, as big as you wish, right? Depending upon definitely what kind of uh, subscription level you have with TradingView. Because if you have a free account, you can only apply it once. But yes, on paid accounts, you will be able to apply it multiple number of times. So here you can see I've given a list of about 40 symbols, and then I'm telling the screener that out of these 40 symbols, identify the symbols where my proximity to the demand area or to the supply area is 1%, which means I only want symbols where the current candle will be within 1% to a demand area or a supply area. And can you see it gave me a list of 1, 2, 3, 4, 5, 6, about 7 symbols. So now I don't need to analyze all 40. I know these are the only 7 symbols where I'm pretty close to the demand areas. So example, if I go to BPCL, you will see that on BPCL, BPCL, we will be close to a demand area, and that is why it is getting shortlisted for us. So here you can see we do have this drop base rally, and the current candle is pretty close to it. That is why it got shortlisted for us. And currently I'm on the daily time frame. Now just as an example, if I change to weekly, now it will give me the results for the weekly time frame. That out of those 40 symbols, where am I close to a weekly demand area or a weekly supply area? So like in this example, can you see this giving me Grasim, Wipro and NTPC? So let's say I go to Wipro. So you will see on Wipro on the weekly chart will be close to a demand area. In fact, you can see we had a formation of demand area where the current week was the leg out, right? So you can see as soon as the zone is completed, because the current candle is close to it, it got shortlisted for us. And that is how the screener basically works. It helps you identify symbols where the current candle will be in that proximity range, and that proximity range you can set as per your preference. So that is your step number 2, that you need to find a smaller list for you. How you get that smaller list is completely your call. I showed you one website with over 150,000 scanners available to you. I showed you 2 scanners which are based on demand supply zones. But again, I'll add, these scanners are only to help you shortlist symbols. They are not call giving or tip giving services. They are helping you get a smaller list. How you get that smaller list is completely your choice. These are some of the options that are available to you. This process can also be as simple as that I don't want to use any of these scanner screeners because I want a small list. I will only be analyzing my Nifty 50 stocks every day, or maybe I have my own favorite list of stocks which I only want to analyze every day. So choice is yours how you want to get that small list. But once you have your list, you are ready to move ahead, because now what you'll do is you'll analyze all these symbols one by one, and whatever matches with your trade plan is your opportunity. Whatever doesn't match with your trade plan, you simply skip it. So next step is we need to go to the lower time frame. So the question is, what is my lower time frame? And we got the answer when we did our step number 1, which is what are my time frames as a monthly income trader. We got to know these were the time frames we'll be using, and out of these 4 different time frames, my lower time frame is daily. So now I know that lower time frame here implies the daily time frame, and on the daily time frame, I need to identify zone. And by zone, we mean any of these 4 structures. It can be a drop based rally, rally based rally, rally based drop, or a drop based drop. So if I go back, since I'm using the demand and supply zone indicators, so the fact is I don't even have to identify the zones. The indicator does automatically for me. But when you went through the basic lessons, advanced lessons, the theory part, we also learned the process where we use boring and exciting candles. So if you want to use that boring exciting technique, yes, initially you can use it because it helps train your eyes how to identify these areas. And the boring candle indicator and the explosive move indicator, which we have created, are absolutely free indicators. You can use them for free forever. But I prefer to use the demand and supply zone indicator because it is much more advanced. It is not based on boring exciting technique. It is purely based on the flow of the price, which is what we also call as price action. Plus, this also helps us in multiple time frame analysis, which makes the process much faster, mechanical, and easier. So yes, here you can see that even if you're visually seeing the chart, you can identify that we have a rally, period of pause, again a rally, which is a rally based rally structure available to us. So what we'll do is we'll draw the zone, and now we have done our step number 3, which is identify zone on the chart. So we have identified the zone on the chart. Now once you have identified the zone, the next step is uh, is the zone available? The answer is yes, we have identified the zone. So now the next step is you can't trade that zone blindly. You will have to qualify that zone. And for qualification, we have a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify based on the booster scoring. So the very first thing we check is that can this zone be a case of level on top of level? And why are we starting with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So if your intermediate time frame zone is getting divided into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which is called as a coinciding level. So if we have a coinciding level, it might be a case of level on top of level, but if you don't have a coinciding level, it cannot be a case of level on top of level. So that's my lower time frame zone. And if I go to the intermediate time frame, which in this case will be weekly, you can see wherever my lower time frame zone is, we don't have any intermediate time frame zone, which implies it is not a coinciding level. And since it is not coinciding, it cannot be a case of level on top of level. So the very first condition, level on top of level, not applicable. Now this zone is not because of a gap, therefore gap rules will also not apply. Next, it is a rally based rally structure. Therefore, pivot non-authenticity is also not applicable, and not even unstable equilibrium, because for unstable equilibrium, the leg out should be going below the basing, which is not happening in this case. So the fact is that out of all these conditions, none of these conditions are applicable. And if these conditions are not getting applied, they cannot disqualify the zone, right? Only if these conditions are applicable, then you have two possibilities, either qualified or disqualified. But if they are not getting applied, the zone cannot be disqualified. So is the zone qualified for us? The answer is yes. So now that we know that the zone is qualified, we can move on to the next step, which is the booster scoring. So the very first one is freshness. The zone is definitely fresh, gets a score of 3. Strength, we have an explosive move, gets a score of 2, and that is the reason the indicator is identifying it. Time at the zone, we only have one candle, gets a score of 2. Reward to risk ratio, we are taking as an assumption, because based on the arrival, reward to risk ratios can change. Now, talking about location, if I go to the monthly time frame, because curve analysis will be done on the higher time frame, which in this case is the monthly time frame. So here you can see we have monthly demand areas, but we don't have any supplies. Now, when we have such scenarios, how do I complete my curve analysis? I've talked about it many times in the past sessions as well. You have two options. Option number one is you can say, okay, I do have demands, but I don't have supply to do my curve analysis. I don't want to do my analysis on this symbol. Let me skip this and move on to another symbol. So that's the most conservative approach. Second approach is you can make some modifications, but again, those modifications are very logical modifications. And what are we doing here is, if you think about it, from the current market price, if I try to identify where is the nearest pivot high, this is the nearest pivot high from where prices they started moving down. So we understand that if the prices they move down from here, there can be only one reason for it, and that one reason is it has to be supply. The only problem here is that I'm not able to see that supply on this particular time frame. But if I move on to some different time frame, you might be able to see a supply zone here. So just randomly going through some time frames, let's say if I go to weekly, you can see on the weekly we did have a supply zone here. That is where we tested and started moving down. So logically we do understand that yes, if the prices are moving down, it has to be supply. So now what I can do is, because I know it has to be some supply, I can use this pivot high as a reference point. And from that reference point, I can do my curve analysis all the way to the demand, because demand was already available. So this demand zone is my very low of the curve. This is my low of the curve, this is my middle of the curve, this is my high of the curve. But since we don't have a higher time frame supply area, my very high of the curve is missing. So now we don't have 5 divisions, we have 4 divisions, which is perfectly fine. And based on these 4 divisions, I can see that I'm planning my trade in this green shaded area, which is my low of the curve. So we are at a good location to plan a long trade, which will be a score of 1. Now, talking about the trend, I don't even have to do the trend analysis, because in demand supply indicator, we have the feature inbuilt. So can you see, once I'm on the intermediate time frame, it is showing me that I'm in an uptrend. So my trend based on zone violations is also automatically done, and uptrend will get a score of 1. Move from the zone, we need minimum 4:1. So if I draw my, oops, my bad, wrong tool. This is the one I need to use. So here you can see we are pretty close to 4:1, but not an exact 4:1. So currently I'll give it a score of 0. But if you still want to give it a score of 2, I'll say acceptable, because if you think about it, we are almost at 4:1. And again here, the entry is a little above, the stop loss is a little below. If I go exactly from the proximal and the distal, then we definitely have a 4:1 move. But let's stick with what we see on the chart. So since we don't see the prices hitting 4:1, we'll give it a score of 0. Now, talking about level on top of level, we have already verified not a case of level on top of level, not even coinciding, but it can act like a trap. And for that, if I take a horizontal line at the proximal and I start pushing it up, you can see that almost here we have this area which has been acting like resistance, support, again resistance, again acting like support, almost resistance. Again, we are pretty close to it, and that is where prices have again started going sideways. So we have a pretty clean area of support and resistance, and we have now talked about it many, many times that people who follow conventional technical analysis, when they will see this area of support and resistance, they would like to buy at support, and their stop losses will be placed below, which will be sell orders. And if we have a breakout, then the breakout traders will also start selling. So by the time we are into this area of demand, we'll have a lot of selling sell orders coming in, and these sell orders can be because of the stop losses, because of the breakout traders. And what are these people doing now? Two novice mistake number one: selling after a decline in price, which means they are selling cheap and selling in an area where in the past prices have proven to us demand was more than supply, which is the only reason for prices to move up. So yes, this area might work like a trap, for which we have already given it a score of 1. So if you look at the overall scoring, we have a score of 10 out of 10 for quality, which makes it as a high quality zone, but 3 out of 8, which makes it as a low probability setup. So high quality, high probability can be done as a type 2, type 3 trade. But in case we move up first and then start coming back, then we can upgrade it to a score of 2, which will convert it into a type 1 trade for us, but currently it will remain as a type 2, type 3 trade. So yes, after applying the boosters, we got to know that it should be a type 2, type 3 trade for us. Now, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to be ready for the worst case scenario, where we'll do a proper position size calculation based on our risk management rules. Whenever the prices are back, we'll requalify it to verify does it still match with my trade plan, because the markets are not static, markets are dynamic. Conditions are changing almost every other second. So before entering a trade, we need to re-verify does it still qualify. If the answer is yes, we place our order based on the entry type. And once your order has been executed, the last step is your trade management, where step 1 is 1:1, we make it break even. After that, if we get the opportunity to trail onto it, we start using our trailing stop loss unless and until we get the exit. And this is how we plan trades, very mechanically, very rule based. And that is what we have been doing for the last 10 number of sessions. And I'm pretty sure you would have seen some beautiful examples where the trades, they work beautifully for us. And the beauty here is we are always doing our analysis beforehand. It's not that after the trade has played I share with you. So I'm always sharing beforehand, and that is the major reason I don't disclose the name of the symbol, because I'm not trying to give you ready-made trades. My job here is not to give you fish. My job is to teach you how to fish, and that is what we do in these sessions. All right, so before we move ahead into the chat box, let me add, if you are not subscribed to my channel, then do ensure you subscribe to it. That is how you'll be updated whenever I'm taking these sessions. And if you're liking these sessions, then definitely hit the thumbs up button. If you're on some trading groups, you have some friends or family members who are into trading, you can share the link to my channel, you can share the link to my course content, you can share the link to these videos, and that is something which might help other people as well. So let's see what do we have in the chat box. So the very first one is stock name is not visible. So I just answered that, Tushar. This is on purpose. I don't share the name of the symbol, and the reason is because these sessions are not intended to give you ready-made trades. These sessions are intended to help you understand how to do the analysis so that you can do it all by yourself and you can do it. Again, it's more focused on the education, not focused on giving you any ready-made opportunities, and that is why I don't disclose the name of the symbols. And the other reason is that this is a universal strategy, so that it remains as analysis which can be applied to anything. I don't disclose the name of the symbol because now you don't connect yourself to that particular symbol. This could be gold, this could be silver, this could be any ABC company, this could also be some cryptocurrencies, right? It can be anything, right? So the analysis part does not change, and this also helps you understand, as long as you have a chart, irrespective whatever the name might be. The fact is, even if I don't know the name of the symbol, it doesn't make any difference to me, right? The only reason I need to know the name of the symbol is to place my orders. Otherwise, uh, the strategy is universal, can be applied across the board, any markets, any asset class. All right, perfect. See, what do we have? All right, great. So that brings us to the end of today's session. Thank you so much for joining in. I'll be seeing you now next weekend, which will again be our practical session. Till then, trade safe. Enjoy your Sunday. Take care. Bye bye.